Hi folks, and welcome back to Meaningful Money. Okay, I'm still in my field here, just in the little hamlet of St Hilary, not far from Penzance. Lots of people giving me funny looks as they walk past on the road, which is just behind the camera there, or the other road there. Or there's a junction where cars are pulling out there and all they can see is me, but they can't see the camera. So, you know, I'm kind of used to this now, 176 episodes in, people thinking I'm slightly weird. I am slightly weird, perhaps. So we're carrying on talking about mortgages. We just introed the series last time. We're going to talk about mortgage types this time. So before we get into the detail of that, my good friends down here in the bottom right, 7 Investment Management, who sponsor Meaningful Money. So grateful to them for doing so because they help me to keep going. So thank you very much, chaps in London. So different types of mortgage. Okay, what do I mean by that? Well, there are 2 types of type. Decipher that if you can. I'm going to talk about 2 different things specifically this time. The 2 things you need to know about mortgages primarily is, firstly, the different ways you can pay off your mortgage and the different ways the interest and therefore your mortgage payments change and behave. So the different ways you pay off your mortgage and the different ways your interest and therefore your payments behave, the interest rates, right? So let's look at how you pay it off first. Now, the vast majority of mortgages these days are arranged on what's called a repayment basis. Didn't always used to be the case. The alternative to a repayment is something called an interest-only mortgage. Now, as the name suggests, with a repayment mortgage, you are paying your mortgage off as you go. So every month, you're paying the interest which is due and a little bit of your capital that you've borrowed. The idea being that at the end of the term, you've paid it all off. So far, so straightforward. Now, the alternative is an interest-only mortgage, where you just pay the interest, hence the name, interest only, and then at the end of the term, you are expected to pay it back. But how you pay it back is open to question. I'm going to scooch up to the top corner here. It's not really me scooching, of course, the wonders of video editing, because I just want to show you a little graphic, because here we've got an axis, if you like. So on the left-hand axis, the vertical axis even, is the amount of money you owe, and on the bottom axis is time. So if you can imagine, you know, let's do a repayment mortgage first. So this curve here shows you very roughly how you pay off a repayment mortgage. Now, first thing you'll see is that it's not a straight line, that you don't pay off very much in the early years, that the line stays quite flat. You pay off a little bit, but as you get sort of roughly halfway through the term, let's just say it's a 25-year term, then the mortgage starts to drop off quite steeply as you pay more off. So that's an important thing to know, that on a repayment mortgage in the early years, you're not paying off much capital, you're mostly just paying interest. Depends on the interest rate of the mortgage, but that is largely true. Now, on an interest-only mortgage, you can see the line is dead straight because you're not paying off any of the mortgage until the last day when you are expected to pay it all off in one lump sum. Excuse me. So, okay, so I'll just come back into view a minute. So that's repayment and interest only. Not quite as straightforward as you might think in your mind. Certainly the repayment thing, where you would think that you're paying the same amount every month, it would go down in a nice straight line. But it doesn't. It's mostly interest in the early years. Interest only is an issue though, because where are you going to get that money from at the end? Well, I'm sure you will have heard of, depending on how old you are, endowment mortgages. Endowments were a separate plan, a savings plan that you saved up into every month. The idea being that at the end of the mortgage, there was enough in your savings plan to pay off your loan, right? The problem is that many of those were badly sold and, you know, badly put together. They were pretty rubbish contracts. And many people got to the end of the mortgage or halfway through the mortgage and it became clear that they weren't going to have enough in that pot to pay the mortgage off. And that's a big deal, because at the end of that term, your mortgage lender is going to ask you for their money back and you've got to find it from somewhere. So that's, quite a big question. Now, there's all sorts of ways you can pay off an interest-only mortgage. You could save in an ISA, you could save in a bank account, a savings account, but you'd have to save an awful lot of money because you need a decent return to make it affordable. The vast majority of mortgages these days are arranged on a repayment basis because people are understandably nervous about anything where there is a risk of them not having enough money at the end to pay the mortgage off. So repayment mortgage, generally the best way to go. Sometimes switching to an interest-only basis can have its uses. Maybe you need to, some circumstances have happened. Maybe you lost your job, or it's a sort of relationship breakup or something, and one person suddenly has to take on their mortgage on their own, and switching it to interest-only for a short time can reduce the payments, but it's not a long-term plan. Okay, you know what, I'm already sort of nearly 6 minutes into this, so I'm going to talk about how the interest rate behaves next time to try and keep these a little shorter than I usually do. So that's the difference between repayment and interest-only mortgage, an important difference. So I'm going to do one more, I think, and we'll go from there. So thanks very much for watching. Yeah, I think I'll do one more here, while I'm on a roll. And thanks for watching, and I'll see you next time.